as we do every
Recording in progress.
Recordings in progress. As we do every 6 months, we're going to give you a bit of a market outlook as to what we're seeing at the moment. Again, it won't be too economic heavy, just because you all get that yourselves internally in the businesses you work in. But now my clicker's not working. It's always good. Anyway, nothing's working. There we go. Great. But I did want to talk about a couple of things. Firstly, interest rates. We know that inflation came in somewhat stronger than what was anticipated. We've also now seen the federal budget, and the federal government and Treasury are saying they think inflation can be back in the target range by the end of the year. I personally have a lot of doubts about that. And I think a lot of people have a lot of doubts about that. But you can also see that with that stronger inflation read that we've got, the expectations as to when interest rates are going to be cut has shifted significantly. So if you went back 2 months ago, a full 25 basis point cut was priced in for around September, October this year. This morning, this chart's a little bit old, but this morning, the cut's priced in for July next year. So the expectation of when we are going to get interest rate cuts has been pushed way out. And I think for our business and for the property market, it's going to be interesting to see how consumers respond to that, because I think a lot of people that own properties and were looking at buying a property were expecting that, come the spring selling season this year, we would be getting interest rate cuts, and now it's looking more like mid to late next year when those cuts are going to be coming. So I think it will weigh on consumer confidence. Something that might offset that a little bit is the fact that we're getting tax cuts from July 1. Now, they're not huge tax cuts, but obviously that will increase people's borrowing capacity and will just give them more money in their pockets. We've also got the $300 energy rebates now, which it's claimed they're not inflationary, but if you're giving that to every household and people are spending $300 less on electricity, they've got $300 to spend more somewhere else. So I would argue that they are probably inflationary. Just another chart here, just looking at the makeup of household wealth in Australia, which I think it's good to remind ourselves of every now and again. So the total value of assets of Australian households, you can see, is $18.7 trillion. $9.8 trillion of that is in residential land and dwellings. Now, you can argue whether that's a good thing or a bad thing, but most households hold the majority of their wealth in residential property, and especially if you take out superannuation, which is not a liquid asset, you can't really tap into it. Most of the more liquid wealth, not that housing is really liquid, but more of the more liquid wealth is sitting in residential land and dwellings. So when property prices are rising, households tend to feel wealthier and tend to spend more. When the housing market's weaker, we see the opposite. And also, I think politically, there's a driver there for people who, from a government's perspective, the consumer is going to be a lot more confident about things if house prices are rising, and it's more of a vote winner to have house prices rising than it is to have them falling. Moving on to what's happening with the lending environment, what we've seen over the last 12 months is a real slowdown in refinances. The main culprit for this is the fact, firstly, that a lot of people that were on fixed rate mortgages rolled off those fixed rate mortgages early last year. And we've seen a big slowdown in the number coming off over the second half of last year and early this year. And the other culprit is interest rates haven't been changing as much as they were. So there's been less competition amongst lenders, and people haven't been shopping around as much for a better mortgage deal. New lending, though, is up 18% over the past 12 months. But when you look at the breakdown of where the increases come, it's quite interesting. So investor lending is up about 33% over the past year. Lending to first home buyers is up about 22% over that same period of time. And then lending to subsequent buyers is only up 9%. So it's really the investor segment of the market and the first home buyer where the growth is coming from, which is actually a bit of a head scratcher when you think about the market, because sales volumes have been really strong. There's a few things going on though. Firstly, last calendar year, 29% of all property settlements were cash settlements, according to PEXA, which was a record high. So more than 1 in 4 sales was a cash sale. Obviously, you don't rely on finance if you're settling in cash. We also know that the downsizer market has been really strong. So if you're moving out of a more expensive home into a smaller home, you're going to need less finance. And the other thing is we've been seeing a lot more equity being used. So the proportion of people borrowing with at least a 40% deposit has increased quite a lot over the last couple of years. The investor side of things is a bit interesting as well, because we're seeing big increases in lending to investors in each of the major states except for Victoria, where it's only up 6% over the past year. So the fact that the Victorian state government has increased land tax on investors is seeing a lot fewer people investing in that state, and we're still seeing a heightened number of investors selling out of that state as well. And of course that exacerbates some of the rental challenges. In terms of credit growth, even though we are seeing that lift in new lending, overall credit growth is still very moderate, especially if you look back on a historic basis. Over the past year, credit to owner-occupiers is up 5%, credit to investors is only up 3%. Go back 10 or 15 years, it was growing 20, 25% annually. So the higher interest rates, we are seeing more people taking out credit and finance, but we're also seeing higher interest rates encouraging people to pay back the outstanding debt quicker if they've got the ability to do that. And as I mentioned earlier, the new lending environment, so you can see the black line here, which is the proportion of loans that have a loan to valuation ratio of less than 60%. A couple of years ago, it was about 20%. It's lifted to about 26, 27% of the market. You've still got, 42% of all new lending has an LVR of between 60 and 80%. So a lot of people are using quite a bit of equity when they are investing in the market at the moment. Turning to mortgage serviceability, we've still got the 3% serviceability buffer in place at the moment. So the typical owner-occupier variable mortgage rate is about 6.3%, and you're assessed at 9.3%. So borrowing capacity is down quite significantly. And you might have seen when each of the big four announced their results recently, quite a lot of the CEOs were talking about the fact that lending has actually become very conservative, and there's people that should have access to finance that don't have access to finance because of things like the serviceability buffer at the moment. Unfortunately, I don't think those buffers are likely to change. If property prices continue to fall like they did in 2022, I think there would be more of an argument to cut those serviceability buffers. But I think where things stand at the moment, APRA is probably going, well, there's still a lot of sales happening, prices are still rising. Why do we need to remove that serviceability buffer or change that serviceability buffer? And then moving on to the population growth story. Population growth obviously fuels demand for housing. Over the past year, Australia's added 660,000 people to the population. To give you some context, that's a 2.4% annual rise in the population. Over the last 30 years, growth has averaged 1.4%. So the rate of growth is significantly higher. Now, a lot of this is making up for the people that didn't come to Australia during the pandemic. But if you took the trajectory that population growth was on before the pandemic and plotted it to where we are now, we've got more people now than we would have had if we stayed on that trajectory. Natural increase is obviously slowing quite significantly as well at the moment. But if we have a look at who's coming in, we actually got an update to this data yesterday, which I haven't updated yet, but the trend is still very much similar. You can see that the more up-to-date overseas arrivals and departures data, even though the federal government has said that they want to slow migration this year, is not showing much of a sign of that. There has been a slowdown in temporary student visa arrivals. You can see that that has been the major driver of the increase in population over the last couple of years. If you're here temporarily, at least initially, you're not going to be buying a house, you're going to be renting, and this is putting a lot more pressure on the rental market. We did see in the budget that the federal government announced they're going to try and link increases in student enrolment numbers in higher education to universities actually providing some accommodation for these students, which I actually think is a really good move, but I also think the university is going to push back really hard against this. because at the moment things are basically uncapped, and as many people that want to come into the country to study, there's a place made available for them. But the universities get the benefit of those students coming in, but they don't bear any of the cost of those students coming in, such as providing housing for them. So let's have a look. Let's start right at the top in terms of what's happening in the listing environment at the moment. You would have got, hopefully, in your inbox today, our latest listings report for April. April this year is a bit of a tricky month because we had Easter at the end of March this year, and last year Easter was in the middle of April. So you're not really comparing a like-for-like on a year-on-year basis. But what I would say and show you here is new listings over the second half of last year were really strong, and you can see the start of this year, we saw a very strong new listing environment as well. This shaded area on all of the charts is the average over the 5 years to 2022, so 2018 through to 2022. Then we've got the blue line, which was 2023, and then we've got the red line, which is that 5-year average, and the black line is where we are this year. So we have seen quite an increase in the number of new listings relative to a year ago, and they are well above that 5-year average level. The number of total listings on the market is still quite low, although it is 8% higher than it was a year ago, but they're still 15% lower than that 5-year average from 2018 to 2022. So we're getting a lot more stock coming to the market, but a lot of it's actually selling quite quickly, and we're not seeing a big lift in the overall amount of stock on the market. I was looking earlier this week at some of our data, and what we're finding is most properties that sell have been on the market for less than 60 days. So if you can't get your property sold in that first 60 days, it gets very hard to sell that property. It lingers on the market much longer. So about 75% of all sales of properties that have been on the market for less than 60 days. About 40%, only about 40% of the total listings on the market have been on the market for less than 40 days. So about 60% of the stock we've got advertised on our site has been on there for quite a period of time and is now getting hard to shift. And in a lot of instances, people aren't actually adjusting their prices to get that property sold. Now, if we have a look at Sydney, it's a bit of a different story, and Melbourne is also a bit of a different story to what we're seeing in some of the other major capitals. You can see new listings really strong late last year and really strong through the early part of this year, and much higher than they were 12 months ago. If we look at total listing numbers, they're actually mounted quite a bit. They're up 16% from where they were a year ago, and they're 5% higher than that 5-year average level. So there's a bit more stock on the market in Sydney. There's, I guess, less fear of missing out from buyers in that market, and there's just generally less urgency to buy than what we're seeing in some of the smaller capital cities. This is also the case in Melbourne. You can see, again, from the middle of last year, a really strong uplift in new listings, and that carried over through to the start of this year, a pullback in March because we had Easter, a strong rebound in April, but the amount of total stock on the market in Melbourne is quite high. You can see there that it's up 21% from a year ago, and it's 24% higher than that 5-year average level. So this is one of the reasons, as you might be familiar, Melbourne prices are not growing very fast. We've got the data later, but they're up 1.1% over the past year. Compare that to Perth, prices are up about 20%, Brisbane and Adelaide up about 14%, and Sydney up about 8%. And I think a lot of this is being driven by the fact that there is a lot more stock available for sale in Melbourne than there are, relative to history, than there is in the other capital cities. Plus, there's a lot more coming onto the market in terms of new listings. If we have a look at Brisbane, this is where the story starts to change a little bit. You can see that we haven't really seen that uplift in the blue line over the second half of the year. So whereas Sydney and Melbourne from the middle of last year started to see a lot more new listings coming to the market, it hasn't really happened here in Brisbane. And you can see it's pretty much all through last year and all so far this year been below that 5-year average level. And total listings are extremely low as well. So even though month on month we've seen a 34% increase in new listings, and they're slightly higher than the 5-year average level, they're still very low on a historic basis. And total stock is extremely low. It's 37% below that 5-year average level. So there's not a lot coming to the market, and there's not a lot on the market, and that's giving people very little choice. And I think in a lot of instances, in markets like Brisbane, like Adelaide and Perth at the moment, what's happening is buyers are saying, when something good comes onto the market, I need to buy this property because it could be 6 or 12 months before the right property comes onto the market again. Whereas in Sydney or Melbourne, if people miss out on a property, they go, well, there's quite a lot coming, something appropriate is probably going to come onto the market within the next month or two. Again, very similar trends here in Adelaide. Yes, the new listings are higher than they were 12 months ago, but generally over the last 12 months, they've been lower than that 5-year average and quite low. And the total number of properties on the market is also quite low, 9% lower than a year ago, 38% lower than that 5-year average level. So it really is a tale of Sydney and Melbourne. You can lump Canberra in with that, and then the other capital cities seeing quite low levels of new stock coming to the market and a very low volume of existing and total stock on the market. Perth is probably the most extreme example of this. Yes, again, because of the month we're in, we can see an increase in new listings, but very low on a historic basis, and total listings down 23% from where they were 12 months ago. And no surprise, Perth has seen the strongest price growth over the past 12 months because it has the lowest level of supply. Let's have a look at the rental listing environment before we go on to look more closely at what the broader trends are. So in terms of new rental listings nationally, again, this is being impacted somewhat by the fact that Easter has moved around at this time of year. So there were more new listings than a year ago, but new listings are still very low on a historic basis. And then total rental listings are down 28% from that 5-year average. So no wonder rents are rising so much because there's just no rental stock. Why are new listings so low? People that are in a rental property don't want to move because they know it's really tough. Now, that's not a choice that everyone gets, but generally the preference is for renters to stay where they are. But also we've got investors selling out of the market. So we've got, properties that were rental properties becoming owner-occupied properties. And at the same time, we're not building anywhere near enough housing at the moment, so we're not adding rental stock. And if we actually look at a lot of the new housing that is being built, it's actually being built for owner-occupiers. So if you think about a development site here in Sydney or wherever you are online, most of the new housing now is owner-occupied. So a site that 10 years ago would have given you 400 units, and a lot of them owned by investors and rented, you're now probably getting 120 units in that site, and not many, if any at all, of those are actually rental accommodations. So the supply we are getting is very low, but the supply additions aren't adding a lot of rental stock to the market. Here in Sydney, yes, new listings are higher than they were a year ago, but they're 12% below that 5-year average, and total listings are down 34% from that 5-year average level. So again, just not much choice out there in the Sydney rental market. Same story in Melbourne. You're seeing that it's going to be the same story in each capital city. 31% below that 5-year average in terms of the total number of rental properties in Melbourne at the moment. In Brisbane, 24% fewer rental properties overall on the market than there were a year ago. In Adelaide, 22% fewer rental properties on the market compared to a year ago. And if we go to Perth, again, much like trying to sell a property, trying to rent a property, the most dire situation at the moment is in Perth, where the number of properties available for rent is down 40% from that longer term average level. So it's really tough for renters out there in the market. And this is giving landlords the scope to lift their rents quite significantly in some of these areas. So let's have a look at the new homes market and what we're seeing at the moment. So this is based on our project profiles. Importantly, this isn't launches. This is the overall number of project profiles on site. So what we are finding is that new housing market is quite challenging at the moment. The main reasons why the new housing market is so challenging at the moment is interest rates are the highest they've been in 12 years. So financing development and construction is more expensive. A lot of traditional lenders like the banks are not lending for finance or are saying you need a lot of pre-sales to go ahead. So what's happening is they're going to private equity to get the finance, and the returns that private equity want, they simply can't achieve. So a lot of projects aren't going ahead. We've also got a very big gap at the moment between the cost of a new house and the cost of an existing house. And the buyer preference is to buy something second-hand because it is a lot cheaper. What that means for us is, yes, launches have been a bit slower, but it also means things are taking longer to sell. So the project profiles are staying on our site for longer because you've got that elongated selling period out there in the market at the moment. What I always say to developers is the thing that you want is you want fewer listings on the market, because if there's fewer listings on the market, people will feel like they can't find what they need, and then they might be more inclined to buy a brand new property. Well, the other thing you want is more price growth in the established market, because more price growth will mean that price gap between new and existing homes narrows, and there's always going to be a proportion of people that have a preference to have a brand new property rather than an existing property, and they'll be prepared to pay that premium as it narrows. But as it stands at the moment, you can see the number of project profiles on site for each category has actually increased a little bit over the last year. Retirement and land estates have seen a much larger rise in the number of project profiles than apartments have. And then if we look at the number of views per profile at the moment, you can see that the number of views per profile nationally is slightly lower. But the number of inquiries per profile has actually picked up a little bit over the past 12 months. So people are still interested in new homes. I think what tends to happen is, they have a look, they might inquire, but converting that inquiry into a sale is a real challenge in that developer space at the moment. And as I mentioned, one of the big reasons why it's such a challenge is how much construction costs have gone up. So there's three components that are published in the producer price indices about construction costs. You've got the inputs, which is all of the materials, and we're showing you the materials on the side there. So since the start of the pandemic, the cost of those inputs has gone up about 34%. That all gets passed on to the end user. And then you've got the outputs, which is actually constructing. So that includes wages, the civil works, and just delivering the building. So output costs for houses are up about 44% since the beginning of the pandemic. Output costs for other residential, which is units and townhouses, they're up about 24% over that same period of time. But I guess what's a little bit concerning is you can see there's been an uptick in that annual rate of growth over the last couple of quarters. So the price of the construction is starting to rise again, even if the cost of those materials, the growth in those costs is continuing to slow. But ultimately, those costs get passed on to the end user, and that's why there's such a large gap between new and existing property prices. I do get asked quite a lot about why steel prices have come down. I'm obviously not a steel expert, but I would assume that's largely because demand from China has really slowed down for iron ore, and that's probably leading to lower steel prices here in Australia. And if we look at construction now, we know that the federal government has a goal to build 1.2 million well-located homes over the next 5 years. We also know that it's highly unlikely that's going to happen. It's an interesting one. We were at a lunch last year and Julie Collins was speaking, and I you didn't raise your hand, but you put in the questions, and I said, how can you be confident that we're going to build 1.2 million homes when we've never built at that magnitude, and we've got the highest interest rates in 12 years and other reasons? And her response was, we've spoken to the industry and we're really confident. Now, I speak to the developers pretty much every single week. I'm yet to come across one developer that thinks we're going to build 1.2 million homes over the next 5 years. And, the thing that people are blaming largely is the planning at the moment, and there's definitely problems with the planning system, but finance, capacity, all these other factors are also flowing into why we're not getting enough housing built. I think this year is probably going to be worse for housing construction than what we had last year, just based on how things are tracking at the moment. So things are really heading in the wrong direction. And you can also see that obviously if nothing's getting approved, nothing's getting commenced. There's still a lot of housing under construction. The main reason for that is as soon as you go onto site and start doing anything, that's considered to be under construction. So there's a lot of projects that have been abandoned or delayed that are still under construction at the moment, but that pipeline of work behind is really thinning out quite significantly. And I think it will be interesting to see how this plays out. Because when I talk to a builder or a developer, they're like, well, we can't cut our costs. We need the price of existing homes to come up to where we are. But if this continues to fall and we continue to see a real low level of construction, and if this work under construction really starts to thin out, they may not have a choice but to start cutting their prices or taking some losses in order to get some of this construction happening. So it's going to be an interesting tension to view over the next couple of years. Let's have a look at what's happening in the established housing market at the moment and where things are at. So over the first part of this year, we've actually seen a bit of an escalation in price growth compared to what we were seeing late last year. Across the capital cities, prices are up 1.5%. Regionally, they're up 1.4%. Perth and Adelaide are still the standout markets for price growth. There has been a bit of a rebound in price growth in Canberra. Melbourne, still quite sluggish. Hobart, still seeing price falls at the moment. If we take the longer term perspective at the annual rate of growth, as I said earlier, Perth, 20% growth. That's the strongest annual growth in Perth prices since about the middle of the 2000s. So that, remember that Perth prices basically went nowhere for 15 years. We're seeing exceptionally strong price growth at the moment. You can see there Adelaide, 14% growth, Brisbane about 13%, Sydney 7%, and then Melbourne really lagging behind with just 1% price growth. And as I mentioned earlier, I think a lot of that has to do with the fact that there's so much more stock on the market in Melbourne than what we see in some of these other parts of the country. Some of the regional markets are still seeing really strong growth as well, particularly regional Queensland, regional WA, and regional South Australia. When you're looking at Queensland, for example, it's places like the Gold and Sunshine Coast and Cairns where you're seeing really strong price growth. In WA, it's the mining towns again, but it's also southwest WA. Regional SA, I'm always a bit cautious of because there's really not a lot of people that live outside of Adelaide in South Australia, but we are seeing strong price growth outside of that market. If we look at houses versus units, you can see that here. You can see that over the past year, in capital cities, house prices have risen at a faster pace than units, although that gap in growth has really narrowed quite a lot over the last 12 months. In the regional markets, you've seen slightly stronger growth for unit prices than we have house prices. And you can see in certain markets, so in Melbourne, for example, the unit markets outperformed houses. In Brisbane, unit price growth has also been stronger than houses. But in most other capital cities, it's house prices that are shooting ahead of unit prices over the past year. If we look through the pandemic, this is quite telling as well. So it's 4 years and 1 month since we had that first lockdown, which was late in March in 2020. And you can see that capital city house prices are up 41.5%. Unit prices are only up 15.5%. So that gap between unit and house prices has widened substantially over that period of time. But have a look at how phenomenal some of the growth has been. 70% growth in 4 years in house prices in Brisbane and Adelaide, 65% in Perth, 44% in Sydney, but only 20% in Melbourne. So the gap between Sydney and Melbourne house prices is widening significantly as well. You'd have to go all the way back to about 2004 to see the gap between Melbourne and Sydney house prices as wide as it is at the moment. So when I do speak to people in Melbourne, what I do say is I think over the next few years there's actually some scope for some pretty strong price growth in Melbourne, but it's really going to be dependent on the amount of stock for sale reducing and probably also going to be reliant on interest rate cuts coming to fruition over the next couple of years. But that gap between the two has widened quite dramatically. You can see that really showing here when we look at the house price premium between units and houses. So in Sydney, that gap has never been larger. The premium for a house over a unit is about 90% in terms of the median price. And in the other major capital cities that we're showing there, that gap is pretty much at record high levels as well. And if you look at just how much a property costs, so in Sydney, 1.55 million for a house, there's a lot of people that are never going to be able to afford a $1.55 million house. So we're obviously going to need to get more density into our cities and more density into established areas in our capital cities in order to allow people to live in these areas. Because, I mean, even in Sydney, $800,000 for a unit is very expensive. And if you were actually to go and try and find that median priced unit, it's probably a unit in Parramatta, or it's probably a one-bedroom unit in Potts Point or something like that. It's not something you could live in with a family. Let's have a look at sales volumes. So sales volumes, even though we've had that big increase in the amount of stock on the market, we have seen quite strong sales volumes so far this year. Compared to last year, sales volumes over the first 4 months of this year are up about 28% on last year. So we have responded to the increase in supply, and you can see there that the increases month on month in Melbourne and Sydney are quite strong. As more stocks come to the market, we've also seen more buyers coming out of the woodwork. Again, that's going to be an interesting one to monitor over the next couple of months, given that I think a lot of buyers were going, okay, well, interest rates are going to be cut later this year. Maybe now's the time to get into the market. Now that interest rate cuts are looking like mid next year, maybe that slows down some of that buying activity a little bit going forward. If we look at our level of inquiry per listing, you can see that it's actually increased a little bit over the past year. Just as a reminder, in Victoria, you have the statement of information. So there's less need to contact the agent. And quite surprisingly, people don't really like to talk to real estate agents unless they have to. So they choose not to contact them. But you can see, again, Brisbane, Adelaide and Perth, inquiries per listing are higher than they were 12 months ago. And I always say, look at what inquiry per listing was like pre-pandemic. You were looking typically at about 8 to 9 inquiries, and now you're looking at about 16 inquiries per listing. So there is a strong level of demand. Certainly we're not back at the 25, 30 inquiries per listing level we were at during the middle of the pandemic, but it's still quite strong. And then if we look at how long properties typically spend on site, advertised on site, as I said, we are seeing a lot of properties now sitting on site for more than 60 days, but typically when something's sold, it's been on the site for 40 days. A year ago it was 42 days, and that 5-year average, we've got the range in the grey and the red line showing that average, it's 47 days is how long the property's up advertised on site. Now, Sydney, days on site is marginally lower. Melbourne, it's unchanged from a year ago, but you can see again, Brisbane, Adelaide and Perth, it's dropped relative to where it was 12 months ago, speaking to that strong demand, that low level of stock, and those very big increases in prices we're seeing at the moment. So where do we think property, the market's going over the next 12 months? So I think generally, and I've probably talked about this previously, if you look over the last 4 decades or so, we've had really strong price growth, notwithstanding Perth not doing much for 15 years, but generally really strong price growth. And that's been driven by interest rates falling from 18% to virtually nothing. That boosted people's borrowing capacity significantly. That's probably not going to be repeated. Credit availability was loosened through the 90s and early 2000s. It's now tightened up quite a lot. APRA steps into the market with serviceability buffer changes, interest-only caps, but also ASIC requires the banks to ask a lot more questions when you're trying to take out a loan now. So it is harder to access finance. And again, I don't think that's going to change anytime soon. You've also got employment participation rates, which are pretty much at record high levels. A lot of that has been driven by more women joining the workforce. So as we've had a lot more dual income households, borrowing capacity has increased as well. And it's hard to imagine we get a significant further increase in the number of women joining the workforce or a significant increase in employment participation. So those 3 drivers of price growth are unlikely to be as strong going forward, which means we're probably likely to see less price growth. Now, if you go back 15 years, a real estate agent would tell you property prices double every 7 years. Then it became every 10 years. Now it's more like every 15 years. And I think, another 5 years' time, 10 years' time, it'll be 20, 25 years. So the percentage returns from property are likely to be reduced over the coming period in my mind. We are, though, really surprised at how strong the level of demand for housing is at the moment, especially when you consider how quickly interest rates increased, how many people have come off fixed rate mortgages over the last 18 months, And people seem to be at this stage at least managing that pretty well. And we're even seeing stronger demand. We're seeing sales volumes up. We're seeing inquiries up. But again, the fact that interest rates might be at these levels for a little bit longer does probably give me a little bit of pause for concern about, are we going to see that level of demand remain? Even though we've started to see an increase in the volume of stock on the market, particularly in Sydney and Melbourne, we've also seen an increase in sales volumes. And we were expecting price growth to be quite a bit slower this year than it was last year. Our view's starting to change a little bit on that, and especially with tax cuts coming over the second half of the year, that will likely increase people's borrowing capacity somewhat, and we could end up seeing even stronger growth this year than we did last year. But that increase in supply is meaning that there is more competition for stock, particularly in Sydney and Melbourne, and there's less fear of missing out in those markets. So that means that vendors have to be really realistic on price, and it means that buyers can be a lot more selective. And it's obviously leading to slower price growth in markets like Melbourne and Sydney than those other areas where we're not seeing that big increase in supply. That high cost of new housing, though, is going to continue to be a challenge. Lost our lights here. There we go. That high cost of new housing is likely to see people continue to preference existing homes. As I said, the best thing for developers will be price growth in the established market, interest rates to come down, and that's the thing that will drive a recovery in that market. But it's still a very challenging market for new housing. But we do need a lot more housing, and we need a lot more infill housing in those areas. Everyone's focusing on their hurdles around planning restrictions, which is certainly a problem, but there's also a lot of financial hurdles. I'm also a bit of a skeptic that people say, oh, you just get rid of planning restrictions and we'll get a lot more housing supply. Like, developers have still got to make a margin and a profit, and there's only a finite number of people that actually have the ability to access the finance to go and construct new homes. But it would certainly lead to more housing than we have currently. I think also that the high cost of renting, which we'll touch on after this, is likely to see people that have the capacity to do so to move out of renting and into owning their own home. Now, that's going to cost them more. It's still overwhelmingly, in most parts of the country, cheaper to rent than it is to buy. But it's that lack of certainty if you're renting at the moment. You don't know if the landlord's going to sell. Is your rent going to go up 10% or is it going to go up 20%? So I think people are going to be willing to pay that premium to have that home of their own rather than being in the rental market. Of course, though, not everyone's in a position where they can make that leap out of renting and into home ownership. And, in Sydney, for example, that's quite difficult. And notwithstanding the fact that rental costs, have gone up significantly more than wages. So saving a deposit is a real challenge as well. Let's have a look at the rental market. So if we look over the last 3 months to April, you can see that house rents were unchanged, but unit rents have increased by another 4% over that same period of time. You can also see here how much we can see house and unit rents in each capital city, but there's still a lot of pressure on the rental market at the moment. If we look over the last 12 months, capital city rents are up are now $630 a week. Regional rents are now $520 a week. The strongest rental growth has been in Perth and Melbourne, and most of the major capital cities have seen double-digit rental increases. In saying that, most capital cities have seen a slower annual rate of rental growth this year than they did last year. So things have slowed down a little bit. I'll quickly flick back to this chart, because one thing I want to highlight to you is just how expensive some cities are. So the median house rent in Sydney is $760 a week. In Brisbane, it's $650. In Perth, it's $650. Melbourne, really lagging behind. I mean, it's still expensive, but at $580 a week, relatively speaking, Melbourne is quite cheap compared to those other major capital cities at the moment. And people in Melbourne don't like hearing that because obviously rents have gone up 30% in the last year, but that gap is still quite wide. Now, if we look at houses versus units in terms of what the rental cost is, during the pandemic, people didn't really want a unit. People wanted a house. We saw that gap widen. we've seen that gap narrow quite a lot. But if we go back before the pandemic, the difference in price between renting a house and a unit was about $20 a week. It's still in the capital cities around $50 a week. So that's probably going to narrow. But I think where we're getting to now is increasingly people just don't have the capacity to pay the rent that people are looking for. So how do you get cheaper rent? There's a few ways. You move to a less desirable location. You move into a smaller house, you move into a unit, or increasingly, the other thing people do is move into share houses. And we've seen on our Flatmates site, pretty much record numbers every month for the last 18 months because people are having to go back into share houses. You're probably not willingly going into a share house, particularly if you're not a uni student, but out of necessity, people are being driven back into share houses because they simply can't afford those rents. So I do wonder if we're getting close in some areas to tapping out how much we can continue to push rents higher. It is, I haven't covered it here, but it's quite interesting when you look across the individual cities at where we're seeing the strongest rental increases and the strongest demand for rents. So if you go to Melbourne, for example, the strongest demand is in the southeast, which is probably intuitively not where you would think. You would think it would be the inner city areas. If you come to Sydney, places like Blacktown are seeing the strongest increase and the strongest demand for rentals. And again, Blacktown's probably not the area you think that most people are desiring to rent, but I think it speaks to the fact that people are being forced further away because they can't afford the rent in those inner city areas closer to work, closer to universities. So how much have rents gone up? 43% for houses, 46% for units over the past 4 and a bit years. Again, have a look at Perth, more than 70% increase in rents in 4 and a bit years. Brisbane and Adelaide, you're looking at about a 50% rental increase. Sydney, 40%, and Melbourne at 35% there. So again, Melbourne lagging behind in terms of rental growth and price growth at the moment. Rental returns. So rental yields are the highest they've been in about a decade if you're looking at units. In Melbourne, for example, inner city units in Melbourne, the rental yield is the strongest it's been in about 15 years. But investors are not coming back into that market because the increase in land tax in that market is seeing a lot of exit. But generally speaking, we're seeing quite strong yields. WA is the most popular area for investment at the moment. And have a look at the yields you're looking at. 5.5% rental yields, 20% capital growth over the last 12 months. It's pretty easy to understand why a lot of money is flowing into Perth. Plus, if you're in Sydney or Melbourne, a brand new house in Perth costs about half of what it would cost in Sydney and Melbourne. And you're 10 or 15, a lot of those new houses are 10 or 15 minutes away from the beach. So it's ticking a lot of boxes for investors in that market. I think also maybe some of those investors have got short memories about what's happened over the previous 15 years, but certainly rental yields have improved quite a lot. Now, if we look at rental inquiry per listing, it's really strong. So nationally, you're looking at 28 inquiries per listing. It has come down from about 31 a year ago, but what I always say is have a look at what was normal before the pandemic. You were getting about 12 rental inquiries per listing. You're getting 28 rental inquiries per listing today. Have a look at Perth. You're getting 40 rental inquiries per listing. Brisbane's at 30, Melbourne's at 32. There is a huge amount of rental demand out there at the moment. And as I showed you earlier, there's not much new stock coming onto the market, and there's very low volumes of overall stock available for rent. So it's an extremely challenging rental market. And rental vacancy rates are hovering at about 1.2%. Again, have a look at what was normal when rents weren't increasing before the pandemic. We need the rental vacancy rate to get back up to around 2.5% to 3% to stop rents continuing to climb. So it's going to be a real challenge, and it's going to take a lot of time. And then if we look at rental days on site, you're looking at 20 days is typically how long something is advertised for. Now, if you're familiar with our site, and hopefully you all are, our sales for sale side of part of our site, we have a for sale section and we have a sold section. And there's all sorts of behavioural nudges, I guess you'd call it, for us to get agents to tell us when a property's sold and move it to the sold section. We don't have a similar leased section. So we do find that those advertisements can tend to stay up somewhat longer. the general feedback I've been getting for the last 12 months is most rental properties, you have the open for inspection, you get a heap of inquiries, and that property's essentially off the market after that first open for inspection. So things are moving really quickly. And we're measuring like for like. You can see days on site was 20 days in April. The 5-year average is 25 days. So it's certainly indicative of strong demand for rental accommodation. So to sum up what we're seeing in the rental market at the moment, we're seeing rents climb. Obviously, they've climbed quite a lot over the last 4 years. There's a few factors that have really driven this. Big reduction in household size during the pandemic. That has started to revert a little bit, but the latest data from the Reserve Bank has actually showed that the increase in household size has flattened, and it's flattened at a lower level than what it was before the pandemic. So smaller household sizes drive more demand for housing. Housing construction is extremely low, as we've talked about already. That means that you're getting fewer supply additions in the rental market, and we've got a rapidly growing rate of population growth, mostly from migration, mostly people that are here temporarily, mostly people that are then going to rely on renting in the market at the moment. As I said, I think the capacity to pay the price that people are seeking for a rental property is going to increasingly become a challenge. It was great to see in the federal budget that rental assistance has increased. The government also seems to be putting a lot of faith in the build-to-rent sector, which doesn't really address affordable rentals. If you look at the build-to-rent projects that have happened to date, most of them are very premium rental stock, and that's not really helping people at that lower end of the market that can't afford anything. We've spoken about this, but people are moving to less ideal locations. They're moving to smaller properties, or they're shifting back into share housing, or if they've got the ability to do so, going and living with a family member instead of paying rent in the private market. So how do we address things? I mean, this is a supply and a demand problem. So if we look at the shortage and we look at what we can do on the supply side, even if we fixed everything that was wrong with housing supply that was a barrier to housing supply today, it would still take 3 to 4 years for that stock to show up. So what we really want, the best way to fix this is to get more investors into the market. But that's challenging. No government is going to give incentives to investors. It's much more appealing to give incentives to first-home buyers. But we need to find ways to attract investors back to property. It makes new development a lot more feasible, and it increases the supply quicker than building. On the demand side, what can we do? We can lower migration, which the federal government's now starting to try and do, but it's going to be interesting to see if that's actually effective. And even if we bring in population growth down to 1.4% on an annual basis, we're not even building anywhere close enough to cater to that level of population growth. They did increase rental assistance in the federal budget, which will help. We got 15% in last budget, and we got 10% increase in rental assistance this year. That was after 20 years of no increase. So a welcome catch-up, but probably still doesn't quite go far enough. The other thing you can do is obviously try and get more people becoming first-home buyers. If people are a first-home buyer, not always, but often, they're exiting a rental property and making that available for someone else. And I think there's obviously an expectation that rents are going to continue to climb, and that should see more investors coming back into the market. I would say, when I say this in Melbourne, I say, maybe not in Victoria at the moment, but certainly in those other states and territories, the strong rental market, the better yields will attract more investors into the market. But I also think it's going to encourage more of those renters to look to exit renting and get their own property. And I believe that's the last slide. It is. So thank you very much for your time. I'm happy to take any questions from here, or we do have the functionality to take some questions online as well. Yes.
Cameron, so Owen always talks about how hard it is to forecast listings, but I guess you guys have to try for budgeting purposes and all that. When you look back over time and you kind of try and look at the forward indicators for listings, what do you find are the best forward indicators? Is it prices or interest rates, or is it different every cycle?
Pretty much different every cycle. I mean, it's very hard to model listings. Quite a few years ago, REA actually brought in someone to try and build a listings forecast model, and it failed spectacularly. So, every cycle, I think the drivers of what, if you looked at what was happening over the last couple of years, any forecast that we've tried to build a forecast model with has been inherently wrong. I think the best way to get a measure on what's happening with listings really is to go and talk to people at the coalface and get that information. I think you can try your models and everything else, but to me, they're generally unsuccessful. It's always a different driver.
Do you think there's any noise? Like, there's always this perception that there's a lot of investors selling out, helping listings at the moment. But I mean, those charts had investor lending growing.
Yeah.
So how do you think about investors selling at the moment? Any sort of temporary benefits in the last 12 months?
So we have a measure where, and I didn't put it in this chart pack. We do have a measure where we try and measure investors selling out of the market. The way we basically do that is we assume that anything that's been advertised for rent over the last 5 years and hasn't sold over that period is an investment property. But there's obviously a lot of properties that don't get advertised because people have stayed in there for a long time and it hasn't become vacant. So it's not an exact science. But what it has showed is since the start of the pandemic, there's been a jump in investors selling out of the market. And at the same time, we saw a big collapse in investors coming into the market. So you've got more people selling, you've got fewer people coming out. Now we're starting to see more investors coming back into the market, but you probably need a lift of that for 2 to 3 years to offset all of those investors that exited the market over the last couple of years. Anecdotally, in Sydney, for example, a lot of people have stretched themselves too far and have now found themselves in the place where they can't afford that investment property, so they're selling. And obviously in Victoria, anecdotally, a lot of the commentary is around the tax changes and the higher interest rates. People have just said it's too hard to hold this investment property anymore, and they've looked to sell that property and go and invest in WA or go and invest in a different asset class. So I think the increase in investor borrowing is really positive, but you're going to need that to persist for a few years to offset people who have come out of the market.
Can I ask just your opinion on house price growth?
Yes.
When I look at all the inputs, right? So demand supply misbalance.
Yes.
It feels a lot like 10 years ago.
Yeah.
Sort of coming out of the GFC where there was access to credit, limited supply, lots of migration. If I look at that combined with the interest rate trajectory,
yes.
I guess history would suggest that prices should be increasing pretty rapidly.
Yes.
Yet your conclusion is prices probably won't grow as rapidly. Is the key difference this time access to credit?
Yes, I think that's and just how high prices are. My view on price growth, and we're actually working on our forecast at the moment, is once interest rates are cut, we'll start to see another lift in prices. Yeah. But at the moment, I mean, borrowing capacity tells you that prices should have fallen 30% and they haven't.
Sure.
And you just wonder how much further they can keep pushing higher. Now, Perth's a bit of an outlier because for 15 years prices went nowhere. But even in places like, southeast Queensland and Adelaide, you look at it and you go, how much longer can this run for? Prices are up 60% in 4 years. It's not really sustainable. And I actually worry, I guess, somewhat that when interest rates are cut, do we see APRA and ASIC actually tighten things even further to try and make sure that it doesn't just lead to higher prices again? Because we now know they have a willingness to step in with those macroprudential policies. Perhaps they'd be more prepared to use them in future as well.
Just on that, because last year record number of cash settlements of transactions, and something that we're reading about more in the papers is this kind of intergenerational wealth transfer, but it's happening before people are dying. You know, like they're buying their kids' properties. I don't know if you've thought about that or integrated that into what's like the outlook for pricing as well, like if there's just more cash behind
it's certainly something you need to factor in now, and there's definitely a case of the haves and the have-nots of the parents that can help them. I think that's definitely fueling some of the price growth, and there is going to be a huge amount of generational wealth, and I think this is one of the reasons there is going to be more pressure from the government to look at taxing housing in a better way, because mean, I even know with my parents, they bought their house in 1983. They're probably at the age where they need to downsize, but their response is, well, why would I downsize? Like, if I hold on to this property for another 5 years, it's going to be worth more. I don't have to pay any tax on that. So I think that there is going to be increasing pressure to look at, obviously, removing stamp duty, land tax, and maybe even a discussion about capital gains tax on the sale of the family home. Although it would be a very bold government to actually do that. But I think there will be more of a discussion about that. Yes.
What are some of the forward indicators you would have to see before you had a view that house prices would actually fall?
Yeah, in terms of seeing house prices fall, I think we'd need a lot more supply on the market, probably more distressed selling than what's really evident at the moment, and also probably more moderate rental growth, because obviously if people, you need shelter, so you either need to buy a house or you need to be renting a house, and yes, it's cheaper to rent at the moment, but the cost of renting is escalating quite significantly. So I think you'd need to see an oversupply of rental stock and weakness in that rental market as well as a sort of precursor to a slowdown or a fall in property prices. If anywhere was going to see a fall in property prices, obviously we're seeing a moderate fall in Hobart at the moment. Melbourne's probably the most likely candidate just because there is a lot more stock on the market at the moment. But it's not our base case. Our base case is a pretty flat Melbourne market at the moment. And again, sort of longer term, I think when you look at Melbourne, that pricing differential is massive between Melbourne and Sydney now. And at some point, you'd have to think that that's going to drive more people to want to buy in Victoria and in Melbourne and start pushing prices higher again. We've got some questions on.
I've got a few online. So the first one was, Owen mentioned national new listings would be 2% above the long-term average. What are the percentages for Sydney and Melbourne? The April 2024 percentages were helpful, but keen for an FY comparison too.
We'll have to come back to you on that one.
So I can answer that.
Alice is going to answer that.
Owen's commentary was around if we see flat listings next year, that would be 2% above the average. We don't actually forecast Melbourne and Sydney or other states specifically when we give those numbers. So probably too hard to give you firm numbers, but it's clear to say they're well above the 5 or 6 year averages currently. So would likely still be above those averages, but hard to quantify.
Is there another?
Another one. What's driving Melbourne's new listings strength in particular? How much is being driven by the land tax, Airbnb changes?
Yeah, I mean, it's hard to know exactly, and obviously looking just at listings is not going to tell you anything, but anecdotally, a lot of it is being driven by the land tax. I mean, some of my other working theories are there's definitely a cohort of people out there that are struggling with higher interest rates, but if you look in Melbourne, they've also seen a lot less of an increase in equity. So the areas where people are struggling, maybe they've got more access to draw down on some of the equity they've built over the last 3 or 4 years in those properties, where as an owner in Melbourne doesn't have any access to anywhere near as much equity to access to try and get them through this period. So I think that might also be playing into it. But when we talk to real estate agents, the feedback is largely, it's a lot of investors bailing out of the market at the moment.
I'll do one more from online before we wrap up. Do you have any charts comparing new listings growth versus fixed mortgages rolling to variable mortgages?
I don't, but I know that's Eric, and he sent that to us earlier today. So I didn't get a chance to look at it, but it's something we can have a look at for Eric over the next few weeks. All right, well, we are at time. We're like 20 seconds away from time. So thanks for everyone that came in. Thanks for everyone that joined online. And look forward to seeing you again in 6 months. And I'm sure Alice is going to talk to you before then. But thanks for coming.